Hello guys and welcome. In this lecture we look at the first waves and the best time to trade them. The first wave in a bull market starts from a significant low. A significant low in a market can be defined as a point where a previous 5-wave progression and a 3-wave correction comes to an end. Now this significant low could be the start of wave 1, or it could be the start of wave 1 within wave 3 or wave 1 within wave 5 of an impulse move. It could be a multi-year low on largest degree or monthly low or primary or intermediate degrees. Let's study the significant low and significant high using some examples. In the first example of pound dollar, there are 3 significant price top on different degrees of wave 1 as you see here. These are the skills you will master once you start labeling waves. As we know that each impulse wave is subdivided into 5-wave sequence, so every impulse wave of one lower degree brings along a significant price top. Now I will place a line where the starting point of wave 1 is for all 3 waves, indicating a significant top. In the second example of Australian dollar and US dollar, I want you to repeat the same process and place a line where significant bottom is on this chart. As you practice wave count on your trading platforms and in the next section, you will understand the importance of identifying these points on your chart to start labeling waves. Moving on, as a retail trader, all we need to do is to figure out how to spot a first wave as it begins, because after all, our aim is to look for a trading opportunity. Now guys, spotting wave 1 and trading wave 1 are two different things. It is not an easy task to trade wave 1 while they are in formation, as they rarely have a clean formation. The market tends to build a base after a steep decline, and very often we will get repeated tests of the low in the form of wave 2. This is linked to trading psychology of professional versus retail traders, as we studied in the previous lecture. The best time to trade wave 1 on any degree is after you spotted a correction in wave 2. This is also when you will apply your knowledge of corrections from your last lecture to spot the termination point of this correction to enter a buy trade. Also, we know that wave 2 cannot retrace more than wave 1, so our stop loss is just below the starting point of wave 1. Let's look at few examples to study wave 1. The very first example of wave 1 in a bull market is of Euro and New Zealand dollar. The very first step is to spot the significant price low or the price candle where first wave began. So in this case, it is where the red arrow is. Next step is to label the 5-wave advance. Let's study the subwaves of this correction now. I want you to remember what we have learnt about corrections in the previous lecture to know the type of this correction. As you can see, wave A unfolded in 5 waves, wave B was a minor, and this correction was a deep correction. These are all the properties of zigzag correction, guys. Now, using the Fibonacci retracements, let's understand the trade setup available once this correction came to an end. Look how nicely our Fibonacci zone worked in signaling a buy position. My buy entry is once price reversal occurs at or near this Fibonacci retracement zone. And we know that according to the wave principle, wave 2 can never exceed the starting point of wave 1. So my stop loss is just below the starting point of wave 1. Now let's look at another example of first wave, but in a bear market. In this example, we are looking at daily charts to study wave 1. First step again is to label the 5 wave count within wave 1 starting from significant price top. Moving on, we study the subwaves of the correction. Guys, the general method stays the same, however the key is to read the charts properly, because once you miss one wave, it leads to incorrect wave count on all degrees that follow. This is why the approach you will study in the next section proves so much valuable in wave analysis. Once again, you can see that price reversed at the Fibonacci retracement zones. The sell entry for this trade would be where this bearish candle formed, and the stop loss will be just above the termination point of this correction to properly manage risk to reward on this trade. I hope the examples you've studied in this lecture explain the basics of wave 1. Guys, this also concludes this lecture on first waves, as we look to study the next impulse wave in the following lectures.